Hi, what is compounding? That's what we're going to answer today. But why does compounding even matter? So we're confronted by compounding a lot in finance. Every time there's an interest or a return in something. Do you invest in the stock market or in crypto or whatever else? Well, then compounding works in your favor. Do you have a loan or something like that? Well, then compounding works against you. Let's look at a real world example with investing. So let's say you start with $100. You invest $100 and you have an annual rate of return of 10%. So that means every year your investment grows by 10%. So you start here. This is year 0. And then you have $100. This is money in dollars. So then after 1 year, you add 10%, right? So 10% of 100 is 10. So you add $10. So after 1 year, you have $110. So that would be here, right? So if you were to grow your money linearly, you would then have 120 after 2 years. However, compounding means that you grow on top of your gains. So what happens is that you get 10% of what you then have after 1 year, which is 11, right? 10% of 110 is 11. So then after 2 years, you actually have $121. So it's a bit difficult to put in here, but it would be here with no compounding, right? 120. But actually it's a bit higher. So this shows how even with a sort of lower rate of return annually and with less money invested, and then also on a sort of shorter time frame, compounding already does its magic, so to speak, although it's just math. But if we then sort of imagine this curve to go on, this is what it would be if it wants to do a line. So this is what it would be if it were linear, but with compounding, it sort of goes above and then grows exponentially, because gains on gains, that's what exponential means. And that's basically what compounding does. Compounding, we see, is not magic, it's math. But still, most investors and traders break it, because compounding can only work if you have consistent and robust returns with minimal drawdowns. I hope you're familiar with the concept of a drawdown, but otherwise comment down below and I will make a video on it. But basically a drawdown means the percentage lost since the last maximum value of a portfolio. Meaning, for example, if your portfolio loses 10%, then, and you were previously at a high point, so to speak, in your portfolio, it had its highest value ever, then that's a drawdown of 10%. And you always want to minimize the drawdown, of course, but with trading and investing, drawdowns and big losses can sort of destroy compounding, because big losses reset the base that you're compounding from. For example, a 50% loss requires a 100% gain to break even again. 50% lost doesn't mean you have to make 50% again to make even, but 100%. So risk management, keeping losses as small as possible and minimizing drawdowns is much more important than big home runs, the big wins. So you want small losses, minimize drawdowns, and robust and consistent returns. Everyone knows in investing, the goal isn't to get rich quick. But in trading, that's not the goal either. It's capital preservation and building off of a strong base. That's the goal. Let time do the heavy lifting is the conclusion. And that's the conclusion of this video. So comment down below what else you want me to make videos on, what you want me to explain, any other kind of topics you want me to cover also in quant trading. And otherwise, hit the like button, smash the subscribe button and the bell. And thank you so much for watching.